Okay, and welcome back, students who are taking financial accounting, and we are continuing in the series of videos with the assigned homework problems for chapter 3, doing the short exercises. And we left off with number 7 in the last video, so pick up where on number 8. And again, if you don't understand something, go back and watch the theory videos for the chapter, and or watch the introduction to accounting and bookkeeping videos that are on the student community. Pause, rewind, watch them again in order to be able to try to get down the concepts. And if you still don't understand something, feel free to contact an instructor. Okay, it's teaching accounting is not like teaching the math for business and finance. It's a process, and you do certain things, but it's not a cookie cutter, copy and paste, mimic and replace number type of thing. It's something where it's about understanding the concepts and then applying the concepts to a particular situation. So with that said, let's move on here and get 3-8 here. It says journalize the following adjusting entries at August 31st. All right, so number 1, it says services provided but not recorded. Okay, so remember, adjusting journal entries are, what we're doing is we are looking at our accounts and the balances in the accounts, and we're making adjustments either for correcting entries, in other words, we did something wrong and we need to correct it, or we're making adjustments to correct balances, enter transactions that wouldn't normally get on your books, or in this case here, with number 1, services provided but not recorded. Okay, it wasn't, that entry wasn't recorded, so we're calling it an adjusting entry. So this basically is just like a normal transaction. All right, so we ask ourselves, am I affecting cash? And in this particular case, no, we're not affecting cash. Am I affecting accounts receivable or accounts payable? Well, yes, services provided but not recorded. I mean, why we're not affecting cash? Well, if we had received cash, we probably would have made the entry. But we made a sale, and so we didn't receive the cash, and therefore it's probably on account. So we would be, we're looking at, accounts receivable, and of course accounts receivable is an asset, and we treat accounts receivable the same way we, treat cash. Our accounts receivable was some figure before, but now it's going up. It's increasing by $2,700. So since receivable is an asset and we increase our assets on the debit side, we're going to debit accounts receivable for the $2,700, and we're going to credit, services provided, so it would be service revenue for $2,700. And of course, we would have the date as part of our journal entry, which would be 8/31, and that's the adjusting journal entry we would make for number 1. Okay. All right, number 2. 8/31. All right, salaries earned by employees but not recorded. Okay, so $3,200, and if there's salaries earned but not recorded, that means we haven't paid them out yet, and so we owe that money to the employees. So that's going to end up being a salaries payable, which is a liability account. And for our liability accounts, when we increase the liability account, we increase it on the credit side, right? So we're going to credit salaries payable for $3,200, and debits have to equal credits, so we're going to debit something else. And when we look, we know it's not an asset, we know it's not liabilities, we know it's not equity, It obviously isn't revenue, so under our expense accounts, you'd probably see a salaries expense account. So we're going to debit salaries expense for $3,200, and that's the adjusting entry for number 2. Okay, let's see here for number 3, accrued interest on notes payable for $260. Okay, so it's accrued interest on a note payable. So we're accruing interest on the note payable, right? Well, if it's note payable and we're accruing the interest, we're going to pay that as part of our note payable. So that would be something like an interest payable, a liability account, because we're going to still owe it. You know, we're accruing it, you still owe it. So it would be a payable account, and of course payables are a liability, and we increase our liabilities on the credit side. So I would credit interest payable for the $260, and I would have to debit something else. Well, if it's interest payable, I'm probably going to end up debiting interest expense for $260, and that would be the journal entry for number 3, accruing interest. Okay. All right, exercise 3-9. Suppose you work summers mowing yards. Most of your customers pay you immediately after the lawn is mowed, but a few customers ask you to bill them at the end of the month. So those that pay you immediately, you know, that they're going to pay you in cash. Those that ask you to bill them at the end of the month, you know, that's generally you're going to bill them on accounts receivable, right? Because it's on, you're giving them on account, on credit. It is now July 31st, and you have collected $750 from cash paying customers for services performed in July, right? So for those transactions, you probably, you know, since you received cash, you'd be debiting your cash, and you'd have to credit something else. So you'd credit a sales account, a sales revenue account, or service revenue, whatever the revenue account is. And that those totals would be $750. Now, your remaining customers owe you $165 for services performed in July. Okay. So if they owe you, you know, that means you're going to be billing them. So you'd end up debiting accounts receivable for the $165, and you would end up crediting, you know, your sales or service revenue for the $165. That's probably the entries you would make when you were billing them. How much service revenue would you record in July according to accrual basis accounting? When you're on an accrual basis, these are your 2 entries that you would have made, and it's asking how much your service revenue would have been during that month. Remember, these would have been you know, whatever dates in the month of July, right? So you would have 750 here and 165 here. So that's 10. So the amount that would end up in your service revenue account or your sales revenue account would be $915. Okay, because those would have been, I mean, you know, I made 2 transactions here, okay, assuming that the aggregate is this 750 and this 165. I mean, it all depends upon your customers. If I had only one customer who paid me 750 and one customer for 165, I'd only have 2 transactions. But if I had 5 customers who paid me in cash and 3 who would pay me that I'd have to bill on accounts receivable, you know, the aggregate, the sum of those amounts, I would have collected 750 in cash, and I would have credited sales revenue or service revenue for the 750, and the aggregate or the total of my accounts receivable for all of those transactions would be 165 and sales revenue for 165. But the question is asking how much service revenue if I was using accrual basis. Okay, so that's all I need to do is look at whatever the transactions were in the service revenue account, however many there were, and they would ended up totaling the full $915. Okay. All right, 3-10. Closing entries. Let's see here. From the following list of accounts from the adjusted trial balance, identify each as an asset, liability, equity, revenue, or expense. Most of the detailed account type, use the most detailed account type appropriate. Also state whether each account is a permanent account or temporary account, and whether it is an account that gets closed at the end of the accounting period. Following the accounts is a sample of the format to be used. Okay, so for the example, they're saying, okay, we're going to start off with supplies, and we want to know what type of account it is, the category of account. So they're saying it's an asset, and whether it's a permanent or temporary account. Well, all asset accounts are permanent accounts, and permanent accounts don't get closed out. Only temporary accounts get closed out. So you're going to go down through these 7 and just list these using the same information. So number 1 is depreciation expense, and it's depreciation expense because it says expense. That means it's an expense account. Okay, and expense accounts show up on our income statement, so they're temporary, right? Why? Because balance sheet accounts are permanent accounts. Income statement accounts are temporary accounts. Temporary being that they get closed out at the end of the accounting period each and every month. The balance sheet accounts are permanent because they reflect the balance in the account from the start of the business. But each and every accounting period, income statement accounts get closed out. So if it's a temporary account, that's going to be yes, it gets closed. Right, then we have sales revenue, and because it's a revenue account, right? That's the type of account, and because it's on the it's a revenue account, it's on the income statement. It's temporary, and yes, it gets closed out because it's on the income statement. Now, building, right? Building is an asset, right? It's something that's owned, all right, by the business. So that's a permanent account, and we don't close out permanent accounts, so that's no, all right, because it's on the balance sheet. The same thing with cash for number 4. That's an asset. Cash is an asset. That's a permanent account, and that does not get closed out, right? Right. Unearned service revenue. Okay, because it's unearned, and even though it has the word revenue, you can't just say it's a revenue account. That's revenue that hasn't been earned, which means we still owe it. So this is a liability account. Okay, and liability accounts are on the balance sheet, so that's a permanent account, and that does not get closed out. Okay, prepaid rent, right, is the the opposite side of the coin for unearned service revenue. Remember, when you're when you have a place in the mall, and this is I like using this example because it makes it the easiest. When you are Macy's or Sears in a mall and you prepay your rent, the mall owner gets the opposite side of the coin, which is the unearned service revenue. Okay, for you it's a prepaid rent, but the mall owner, it ends up being unearned service revenue. So if it's unearned service revenue as a liability, right, then the prepaid rent has to be an asset, right? Because it's something you own. You still own that cash. Sure, you gave it to the mall owner, and that's why he owes it to you as a liability, all right? So prepaid rent is an asset, and that is a permanent account, and that does not get closed out. Okay, and the last account I'm going to just do up here is dividends. Okay. Now, dividends are not, it's not something you own, and it's not something you owe, even though you do end up paying out dividends, all right? But where does it come from? It comes from equity, okay? When you have money in retained earnings, it can be decided that you want to pay some of that money back out to your shareholders. So dividends ends up being an equity account. Right? It isn't revenue and it isn't an expense. All right, it's not on the income statement. Dividends shows up on the balance sheet, right? But it's not an asset because you don't own them. And even though you'll end up paying them out as a dividend payable when you put it on your books, your declaration of it comes from the equity accounts because it's part of retained earnings. You're going to take it out of retained earnings. And since it's equity, it's on the balance sheet, so it's a permanent account. And of course, when you're sitting there saying, well, this is a permanent account, all right, I'm sorry, it's not a permanent account, it's a temporary account. Just because it is on the it's an equity account doesn't necessarily mean it's permanent like your assets and liabilities. Common stock or retained earnings are permanent accounts because they don't get closed out. The equity account, the dividend account, is the only account on the balance sheet that actually gets closed out because remember, we're taking it out of retained earnings. Okay, so we have to get rid of it and zero it, close it out. So that's why it's a temporary account. So yes, it gets closed out. Okay. All right. So that's it for 3-10. If you have any questions, feel free to give a call and speak with an instructor. But I'll see you in the next video for the next problem.